Bob, the last time we had you on the show, we discussed the roadmap to a recession. And one of the sort of key discussions ahead of a recession is whether interest rates are sufficiently tight to actually create that recession. Given what we've seen in fixed income space over the course of the past quarter or so, do you find the likelihood of a recession to be much lower than the last time we talked with you?
Yeah, I think the main one of the last time we talked a lot about what were the policies going to be, in
Mm,
particular, what was the Treasury policy going to be, and then also what were Fed policies going
mm,
to be, and how are they going to transpire. And I think what we've seen in part because of a shift in stance, and in part because of an extrapolation, a big shift in the expectations of future policy, and those interest rates, which had been starting to create those elevated interest rates had started to create some weight on asset prices, which was necessary to start to slow the economy down. Those have come off. Right? We've had 120 basis points move in the bond yield. We've had equity prices move up considerably over the course of the last 10 weeks. You put those things together, and we've taken a step back relative
mm.
to the path that maybe we were on through the end of October. It looks a lot more like we're back to where we were, frankly, in early 23.
Mm.
Conditions look very similar to where we were in early 23, a lot more similar there than they were in October, let's say. And so what that means is the timing, the dynamics, the ordering, all of that remains the same. It's just we step backwards. And so that means the odds that we get to a recessionary environment are further out, but the mechanics are still the same. And that's really important, which means we're only going to get there. We're only going to get to the slowing of the economy with another rise in bond yields, which then starts to bring equity prices down, which starts to kick off the slowdown in the economy. And so the ordering matters. Eventually, we'll get to recession at some point, but we won't get there until we get back to the meaningful bond yield rise that we had started to see through the end of October.
So pairing this with positioning out there, Bob, is the pain trade still higher interest rates from here?
I think so. I mean, in a lot of ways, what we've seen is a big flood, particularly in the last couple of months, into the bond market. Again, on those expectations that that the yields looked good and that the recession was coming. And so, where is the pain here, particularly in the bond market? I should say, the bond market pain is essentially nothing changes,
Mm.
and we get an unwinding of that pricing. Remember, there's still something like a 70% probability of a cut priced into the March short rate curve. I mean, where is the data that supports? Where is the evidence that supports a 70% probability of a cut in March? The economy would have to essentially instantaneously fall off a cliff for that to make a ton of sense for the Fed to do. And that's just the start of the overall expectations that are going on in that market. So the pain trade for bonds is basically nothing happens in terms of the macro economy. We keep chugging along. I think the pain for stocks is a little bit different, where growth expectations are still elevated in stocks, probably not so elevated that fine growth outcomes won't allow for continued modest rises in stock market. Really, there for stocks, the pain is a meaningful economic contraction or decline, which, as I say, seems like a low probability event given the distribution of things that we're seeing in the macro economy.